All right, welcome to Charts and Coffee Gang. Good to see everybody. Happy CPI Tuesday. Maybe not so happy. We'll take a look. I'm sure a lot of bears are out there saying "told you so," and a lot of bulls are saying "what just happened." I'm gonna let you know how I'm interpreting what's happening with the CPI, both in the long and short term, which I think is going to be very important, not only for what we're going to do as traders between now and the end of the year, but gang, throughout your career, uh, we are going to have to always think about time frame and time horizon, and ultimately the time horizon question goes to, what am I going to expect for the morning? What can we expect for, say, the afternoon? And then what can I expect going into the end of the year? One conversation is very much a short term, say 2, 5, 15, 1 hour conversation. And the other might be a daily time frame conversation. And therefore, we don't have just one opinion. The markets are going lower, the markets are going higher. It's on what time frame are we setting up the trade, and what does that then map out to in terms of expectation for that follow through. And I think that's where a lot of traders start to get, in disagreement or confusion or whatnot about anyone's analysis. Probably the first part of any conversation that two traders or a group of us should have is, Ron, what time frame are you looking at? What time horizon are you talking about? Because without that, analysis really is meaningless. And if we start taking time horizons out too far, remember, the further out your time horizon, the larger your risk, right? The larger your risk. Meaning, if you're going to tolerate, for example, well, let's look at it on the S&P, right? Let's say, for example, you're thinking that there's going to be new lows. I think there's going to be a move to the upside, but from wherever we're thinking about where the market could go, remember, targets are not trades. Even though they masquerade around like that, targets are not trades. So let's say someone who got bullish at 4,000, and someone who got bearish at 4,000. So we'll put the bulls and the bears, their shorts and longs at the same spot. How much higher through 4,000 could a short seller tolerate the market to go higher? I'm pretty sure most short sellers of the S&P could not sit through a 300-point move against them to the upside. Now, that same trader who's long from, say, 4,000, how much could they tolerate the market moving lower against them? So we always got to remember the journey to the target matters, right? Now, lots of unscrupulous analysts and traders will start to talk about, well, see, the target was hit, with no mention of how it got there. We know, we're in the trenches. We're putting these trades on. We feel it. We know the journey to the target is everything, and timing is everything. So let's dive into a little bit more of that. We are still in a choppy market. We are still very much looking at the Fed target rate probability being at that same zone of, say, 3.75% to 4%. But what's happened now? That 4.25% is now, and this is what, almost 35 minutes after that CPI. Why are equities selling off? We are having to once again, and I was just on Benzinga at 835, and this has actually gotten a little bit higher since then. We are now once again having to deal with first the adjustment from 3.5 to 3.75, now 3.75 to 4%, and now it looks like a slight possibility for 4 to 4.25. But what does that mean, really? That just means that we're going to peak a little bit sooner. And this has actually moved a lot since I was just on Benzinga 20, 30 minutes ago. It now seems that we're going to peak and plateau in December again, but at 4 to 4.25%. That's why we have to sell off. But as long as it doesn't get any worse, this is now known. So if there's a filter that I would recommend everybody have to not get sucked into the drama and the hyperbole of the market, traders out there with giant way higher targets and traders out there with way lower targets. That's hyperbole, and it doesn't take account the journey to that level. Therefore, it's quite frankly pretty useless. However, if we know the market's not going to be surprised by more aggressive rate hikes from now forward, in many ways, the worst is behind us, right? So whatever we know or whatever we've had a chance to respond to now has less of an impact in terms of a shock. And that's where we are right now, gang. Now, near term, yeah, I'm gonna look at this market as a true gap down, bearish day trading sentiment to start the day. We closed the gap up from Sunday, and now we might be heading down to 4,000. Who knows? And testing the major psychological level. Let's be real for a moment. Are we going anywhere new? Remember, I said new should be that filter. Are we going anywhere new? Now, all the bears are going to come out of the woodwork and say, see, and all the bulls will have their excuse too. We don't really want to be either. We just want to trade what we see. But are we going anywhere new? Not even a little bit. We're just going right over across a well-worn path. That's where we can sit back and say, "Oh, short-term trade this, and I'll wait for the next setup to present itself." Okay, so I hope that helps as just sort of the precursor of what we're going to get at the bell, which is likely going to be a little bit of an echo of what the 8:30 hot zone was like. So when I say echo, meaning whatever that 8:30 hot zone gave us, we'll see a little bit of that at 9:30 with the Wall Street bell. Okay, so let's jump into the questions, and I'm on the YouTube channel right now. And that question is starting off with Wheezy asking, I get market money math, cool, for options buying, but not for futures. Sure, it's the same. Wheezy, it's the same. I would say if you're going to futures day trade, drop the max to 3%, but it's the same numbers. So when you ask how many micros would you buy, again, run it through the same way. You know what each point of the macro represents in terms of gain or loss. When we're talking market money math, we're talking about managing risk. So you know what each point of the macro represents to your account. You know how many contracts you're allowed to trade. It's the same thing. Crunch those numbers, and it would be the same thing. However, the same mindset applies. So I would say ratchet it into 3%, especially if you're day trading futures, but then find out what 3% of your account is, and that's going to dictate your contract size and or your stop. So same process. You got to know the dollar amount per point, multiply that by the number of contracts. All right, next up, what are my thoughts on why the VIX is going in the same direction as the market? So I'm presuming that's a intraday question, Isaac. So VIX is moving higher, so I'm not quite certain what you mean by that, my friend. Yeah, I don't see the correlation, a positive correlation between the two. So let me know specifically what you're looking at. I think the VIX is quite choppy. Obviously, with the drop in the market, the increase in volatility, we're ticking up, and I take a look at the VX futures contract. All right, next up, Mike asks, CPI and core CPI both came in overestimate. Yeah, I think by 0.2, right? And everything collapsed. Hotter inflation means what? The Federal Reserve must tackle that by doing what? Hiking rates. And that's where that extra quarter point now is being factored in to take us to 4 to 4.25. So again, higher rates are going to be negative to stocks. So help me understand, but does that mean prices are still rising, more inflation? 0.2, I can't say 0.2 is just a dramatic increase in inflation, but it's not moving lower, right? And if you think about the fact that we're in a fairly mature rate tightening cycle and we're still not seeing inflation drop. But by the way, the joke's on all of us collectively, because the fact of the matter is higher rates have never mapped to controlling inflation. Stopping printing does. So when you want to see a correlation between inflation and something the Federal Reserve is doing, it's not the rate hikes, it's actually the M2 money supply. And I know I've shared that image in the past, and I'm actually looking for it on my other screen, and I don't know that I have it handy, but if I do, I'll be more than happy to share it. Is this it? There you go. Inflation follows the money. This is from the Bureau of Labor Statistics and the Federal Reserve themselves. The cyan line is the printing, the M2 money supply. That pinkish line, that is core CPI. And it's a lagging correlation. They're not tick for tick, right? Look how it's going to map to the downside as long as M2 continues lower. All right. Next up is Peter asks from our free trading room for the ES chart. Do I have the overnight data turned off? So Peter, for futures, there's no such thing really as overnight. Futures trade through the Asian session, the European session, the UK. So I keep it on because I want to see, while it's overnight to us, to your point, I do want to see what the opinion and the sentiment and the trend or the chop or whatever it was that the Asian session, the European and the UK, even the Asian close showed us. And I want to see pre-market as well, which would include, of course, what happened with CPI. So I do not turn that off because I don't really look at the S&P futures as something that's part of the Wall Street Bell 9:30 to 4 window. I look at it more as a global reflection of those stocks in the S&P. So no, simple answer is no, I don't. What is the white dotted line? So the white dots are propulsion, the 200 exponential moving average crossing with the 8, Monica. Okay. All right. Raise rates usually lead to less printing. Well, they're two different levers, Vic. I agree. Usually, what's the point in continuing to print if you are hiking rates? But remember, we did, meaning we as in the U.S. central bank did. So you really want to look at them separately. You want to look at what the target rate probabilities are and what the current central bank rate is. And you want to look at the M2 money supply separately. So yes, generally speaking, they both those knobs, right? While the knob for the higher rates is being turned up, the knob for M2 money supply will be turned down, but they don't necessarily happen at the same time. Same thing with asset purchases, right? We would think as the Federal Reserve is hiking rates, we continue on with asset purchases. We are. And for a brief period of time, we're ticking up in the asset purchases. So they are separate things that are controlled separately. Okay. All right. Next up is from our YouTube channel. By the way, we do Charts and Coffee Monday through Friday, 9 to 9:20 right here at the Simpler Trading YouTube channel, as many of you know. All right, PP Family asks, kindly let us know where the NAS and the S&P will take support. You know, when we are looking at, and great question, we are still digesting what CPI means. And like I said, I was at 8:35 I was on Benzinga looking at those same Fed fund futures, talking to the crew there. And here, fast forward, talking to you all now at nearly 9:15 Eastern, those Fed fund futures target rate probabilities continue to be changing, continue to be in a state of flux. We're going to see even more volatility, 9:30 to 10, which is that clearing range. We'll see even more volatility then. So let's take a read after 10. We have already closed the gap. So that did not act, to your question, that did not act as support. The other thing I can do is I can jump over and take a look at sort of what I look at as sort of a secret, not so secret weapon. And that is price-based volume. What's really interesting, gang, so a lot of folks will say, well, you know, CPI set markets lower. Do you see that line right there? That's the point of control, gang. That's the point of control. And we got up to it and we're testing it a little bit yesterday, but you'll notice that's a big old volume ledge. That ledge right there, based on the most number of contracts at that price, that's resistance. The next thing I want to keep an eye on in terms of what the reality is for us in terms of support, some of that's going to be time. So let's wait till after 10. Another thing we can do if we want to project some potential levels, which I know it's something that a lot of you might be curious about, I am too, is let's do this. I'm going to grab you know what, let me go back to because I don't see a lot of volume until about 39.70. About 39.70, that's our next volume ledge in that area. Let's go back to our TradeStation charts, or I'm sorry, our think or swim charts and pull a quick Fibonacci. All right. So Fibonacci is pretty subjective. It depends on what minor high, minor low that you want to pick. I don't find it to be an objective tool, but it is powerful. It's a mathematical law of nature. So if I take this, so I like to go minor high to minor low. So there's my minor low at the low. Let me make sure everyone's on the same page. This would have been the low from September 7. And then I'm going to go to the high from yesterday. It's going to put me right about there. We're at the 50% right now. So it will be very interesting to see. Now, I know there's golden mean and 38.2. I love, as it's known, the halfback. I think Neil calls it that. I love that 50%, right? 2 steps forward, 1 step back. There's some logic to that. So I'll be keeping an eye on that level as well. So if I can stack perhaps some volume ledges, where are we after 10 a.m.? That's what I'll look at. And that's how I would break down the S&P for that. And again, S&P futures are going to map to SPY and SPX. I don't look at SPY and SPX for the analysis because they're that much more truncated time trade, amount of time trading. I want to look at that much more global, bigger picture S&P futures chart and then let that map to my analysis on the S&P, on SPY or what have you. All right, next up, Nick asks, how do I approach adding to a winning position when holding the underlying? I don't add. Add would mean I've got another setup. It's just really that simple. So under what conditions? I've got another setup. So let's think of it if I were following a trend. Each reversion, each regression, each pullback, retracement, whatever you want to call it, ham sandwich, right? Each time I pull back to the wave is a separate trade. So some traders might say, well, you're adding to the position. Not really, because each one of those entries really is, for me personally, a standalone. Each one of those trades, each one of those entries is its own entry, stop, in other words, the point of validity, as I call it. It's got its own target. It's got its own cost associated with it. So they're independent. So I don't like the jargon or the lingo. I get it, though, of add. I think about, is this a standalone entry? Is it valid to be a standalone entry? And then I'll just enter again, remembering that I want to have amnesia for whatever I did before, because whether it was a good trade or a bad trade, there is going to be sort of an after effect. There's going to be some aftershocks. If it's a good trade, I might be reckless about my next entry because now I'm all jacked up on the win. My ego's flying high. Let's remember, there's no such thing as trading without emotion, right? That's never been the goal. Unless you're Vulcan and your dad's name is Spock, there's no such thing as trading without emotion. That's the biggest lie told. There is going to be emotion behind a trade. However, the trick is not to let the emotion derail our trading plan. I'm going to tweet that. That's tweet right there. That's tweet worthy right there. So the way that I'll look at it is keeping amnesia for whether the previous trade was a loss, was a win, whatever it was, and then treating each one independently. All right. So next up is, bear with me, gang. Is their gold versus real yield chart looking any different? Oh, interesting question. I don't know that it's going to adjust that quickly, and nor do we need it to be that sensitive. Because remember, it's really, I can take a look at the bond market right now, ZB, and then I can take a look at having ticked up in inflation. So what would that look like if bond yields are dropping? Bond prices, ZN, ZB, are dropping. That means yields are going higher. And then CPI also ticked higher. So I would say it probably cancels it out. It's probably canceling each other out because inflation ticked a little bit higher and yields are ticking a little bit higher. So you're not going to see a contraction of that real interest rate or that real yield. So if yields were heading lower and inflation headed higher, the chasm between the two would have a narrower, right? But would be narrowing. And then that would send gold higher. So I'd say it's pretty much status quo. Probably nothing significantly different, Mark, to your question. Yeah, probably not really much significantly different. Gang, thank you as always for joining us here at Charts and Coffee, Monday through Friday, 9 to 9:20. On Sundays, 6 p.m. to 6:30 Eastern. We have our weekly Raghee report. Always enjoy taking your questions. I love what you all are looking at. I love the questions. We've been doing Charts and Coffee here for almost 2 years. And thank you all. I see the questions really. I see you all starting to really understand not what's going on the dumb box, as my mom calls the television, but understanding, okay, this is what I see, not what someone else is talking about. And this is my time frame, and this is how I want to trade it. I love it. I love the discussion here. Love the community. Thank you so much. I'll see you tomorrow. Same time, same station. Be good to each other, gang.